Good morning, traders. This is Brad Matheny. Today is March 4th, early in the morning on Saturday. This is the TTScanner Hotlist video. And before we get started with the hot list, I'm going to go over the general market conditions related to what I believe is going to happen over the next 10 to 12 plus months. Understand that the markets are still seeking a confirmed bottom. So we do have a risk. I would probably put it at around 20, 25, 30% for some sort of a credit event or global banking event to disrupt the markets as we're seeking a bottom. This is the U.S. Valuation Trend Index chart. It's a monthly chart. I just created it yesterday afternoon. You can see we've been unwinding here since really 2020 on this valuations chart. And through 2021, the excess bubble phase, you can see that we've been in this broader unwinding cycle. This is very, very important to understand. The real peak in the market occurred back here in, this is really COVID. This is the COVID recovery. And then at this point with zero interest rate and the excess bubble phase and all the stimulus that's going on, we have moved into a devaluation cycle phase. So understand that through the last roughly, let's do the math here, about 2 years, 2.5 years, we've been in a broad deflationary devaluation cycle trend. Now, how can I say that when inflation has gone through the roof and the markets have gone straight up and Bitcoin's gone from 9,000 to 60,000 or 65,000? You are witnessing a bubble, folks. This is all about excesses. Traders and consumers and the globe was feeding off of very cheap capital, very cheap credit, prompted by COVID, prompted by the zero interest rate policy, and essentially created a massive bubble phase. Behind the scenes, what was happening is the U.S. markets were going up, the foreign markets were going up, Chinese market and Asian markets were contracting a bit, but behind the scenes, what's really happening is we're getting into a devaluation phase. We are seeking a new bottom is what's actually happening. Once we get the bottom like we had here into 2013, early 2014, or back over here, for example, 2010, or back over here, which happened in 2018, then we will go through another appreciation phase. So remember, back here was 2018, early 2018. We reached the bottom and we started appreciating. This appreciation trend here will drive a market to the upside. Once we start to move into this downside trending, this is where we need to start to be cautious, okay? This is back over here, 2020 and 21. This is telling you the markets were still going up, but this is telling you that we need to start being very cautious of the uptrend because we're in this downward cycle trend. Now, where are we at right now? We are dancing around these extreme lows, this 50% retracement. March is likely to become a solid upward trend, just like I've been saying, even though the MENT Rotational Modeling System, which operates on its own quantitative logic, has gone bearish last week. We are likely to see March move back to the upside. I believe we're going to see it move back above this purple line, maybe carry into April a little bit further than I expect. My expectations are around mid to end of April. We're going to find a top, trying to form a bottom. We may end up getting some sort of an engulfing pattern like this. Notice that this is a thrusting pattern. I call it white inside out up. Here's an actual thrusting pattern. Here's a white inside out up. Here's another one, white inside out up. What we have here is basically a good bottoming formation here with the engulfing. Another great bottoming formation here with the engulfing. And what I would be looking for over here, ladies and gentlemen, is another bottoming formation with an engulfing. Maybe March gives it to us. It's setting up right now where it could. This new little March bar in here, take a look at this, is setting up where it could, if we get a rally, form into an engulfing pattern, and that would potentially be a very solid basing bottoming formation here. Remember, we're looking at this as establishing a low in 2010, higher high, higher low, higher high, higher low, higher high, hopefully higher low. Otherwise, we could get some broader breakdown event taking place. So understand that we are really in a seeking a bottom mode right now. We are looking to confirm a bottom. And because we're getting into a presidential election cycle, I think it could be extended possibly 6, 12, maybe 18 months out, meaning we may not actually clearly identify a real base on this type of a chart for another 6, 8, 10 months. But we are likely trying to hold a bottom in this area. Okay, the U.S. leading chart index moved back up above this upper channel. This is pretty solid. If we stay in this upper range where I'm circling here, this is pretty solid for an uptrend. We've got to be cautious of getting back down below this 180 area. If we see some broad pullback down to 180, we could see some real issues moving back to the downside. Okay, and then let me show you one other here. The accumulation cycle phase monthly chart. This gives you a very clear picture of the range that's taking place, and it also shows you that we have about another 10 months before we reach another Fibonacci price time cycle phase. That's going to come towards October, November, December of 2023. So we are very likely to stay within a potential sideways channel, maybe getting up into this 240 range here, that's percentage, and possibly moving back down around the 165, 175 area here. This is all off a percentage chart here. As long as we stay down in this channel here below this blue line and hopefully trending a bit sideways or downward, we are likely going to see the U.S. markets continue to attempt to bottom. If we see a big spike up here and or the fear index moves higher or there's some catalyst event, then yes, we will very likely come down here and attempt to test these lows, maybe establish new lows down in this area, right around the COVID high mark area. But technically, without any catalyst event, I believe we're really trying to hold this bottom. We've got a good solid ABC formation here in the SPY. We are likely trying to form a wave 4 correction, a minor wave 4 correction leading to a minor wave 5 upward move. We'll see how it plays out. I think March could be very powerful, maybe 8 to 15% to the upside on the SPY. Okay, let's go over to metals briefly. Metals are moving back to the upside. I believe we've had this type of capitulation low, almost like the COVID low, or like this blow off kind of a low. We've got a high or a low, a new high setup, and then we've got this kind of a blow off low. I think we've kind of done the same thing. We've got our low, we've got a new high setup, we've got kind of our blow off low back over here, and now we're rolling around looking to try to get into the next move. So hypothetically, we're kind of in this mode right here, which is maybe a combination of kind of a blow-off low formation like COVID, and possibly attempting to move up into the 2200. I believe metals are going to act as a very solid hedge, possibly better than the US dollar, possibly better than the SPY over the next 3 to 5 plus years. So be aware that if we start to see metals really start to accumulate, get above 2100, and I think we're going to start to see a very solid hedge event taking place, very similar to what happened from roughly 2005 or 6 all the way to 2011 in metals. A very big potential 300 to 700% rally in metals, possibly sending gold above 10, 12, 15,000 an ounce. But that's, again, speculation, kind of a guess. Okay. Let's get into the TTScanner Hotlist. This is the value hotlist. We have no new triggers. We're fairly mixed. I know this is very tiny. I apologize. But take a look at the fact that we're bearish, bullish, warning, warning, warning. It's fairly mixed, which happens during a flattening cycle in price. So I need you to be aware that We have no new triggers, which is kind of good, and that happens in a sideways price trend. But we're also searching for a bottom. I would like to see this move back to the more bullish side and start to see this turn green. This is the thrust indicator of the trades that we have active right now. You can see that, move this. We've got some that are 35 weeks, 17 weeks, 14 weeks, 10 weeks, 3 weeks, and looks like 16 weeks. They are holding up. They're not producing great profits yet. In a bigger trend, in a trending market, you would be expecting to see maybe 10, 15, 20% trends in this. But because we're in a sideways flattening market, these things just aren't performing yet. Obviously, when the price is going sideways or nowhere, you're not going to see big returns because we don't have any big trending. Now, when we come back over here to the TTScanner main hot list, we have one new trigger in ITA, aerospace and defense, fairly solid thrusting pattern. Stop is at 115.15. Entry price is 116.16. It looks like we got a little bit in the trade, so this may have generated a midweek. Long and short of it, ladies and gentlemen, this is a good trade setup. Aerospace defense, ITA, looks like it's got a new trade with fairly solid profit factor and win rate. Profit factors at 72.72, win rates at 1.36. Again, I've gone over this many, many times, but given this type of scenario, this would put us in possibly a 40 to 60% allocation range. Meaning if you had created a trading account and broken it into 10 slots, as I gave you the example, you have hypothetically $1 million in your investment account. You would take $900,000 and apply that to the MENT Rotational Modeling System. That's your 90% applied to a very long-term protected investment modeling system. You would then take 10% of your money, $100,000 roughly, break that into 10 or 15 trading slots. That would give you each trading slot would be about $7,000 to $10,000 each. Using these triggers and using these profit factor and win rate, I can determine how I want to apply my capital, and basically a 0.72 profit factor shows that it's not super profitable and it has a win rate of 1.36. This means that in theory I would be applying probably about a 45 to 55, maybe 60% allocation on a $10,000 account. That means I'd be applying maybe $4,500 to $6,000 into this trade, leaving the rest as a effective cash hedge. Okay, so again, one new trade. This looks like maybe the only trade this week. This is the core inverse list. Lots of bearish. This is to be expected in an uptrend. In an uptrend, these things will all be bearish. In a downtrend, they will all be bullish. You can see we've got a number of flat triggers. Yang went flat, EPV went flat, and FAZ went flat. This is likely due to the rotation that took place last week. Remember, in a flattening market, we do not want to be trying to be aggressive. We want to wait for the markets to actually trend. So you can see here the Yang profit, this is HIBS, beta, high beta, bear, 3X shares with a 0.28 profit factor and a 0.50 win rate. This is really would be about 20-25% of your equity allocation. 0.87 and 1.89 on this trigger may have been about 50, 60, 70% allocation. This one, 1.08 to 2.38. This could have been a full allocation of about 10,000. This one is 0.41 and 1.40. Again, very poor win rate, profit factor, moderate win rate. This would probably be about 50, 55% allocation. You can see it's already up 16% after 4 weeks. Nice little trade. And this one, again, because it's 1.14 and 3.2, this would have been a full allocation. So the way, again, that I do it is I essentially multiply these. So, and then I take whatever the number is and try to adjust it by this. So 0.70 times 1.67 ends up being approximately 1.1, 1.15. I'm just doing the math in my head. and then again multiply it times 0.7 would put me down to about 65-70% allocation. That's how I would allocate this based on this trigger. 0.37 times 0 or 0.73 puts me at about, if I do the math right, at about 28, 0.28, maybe 0.30 times 0.37 again would put me down at around 15-20% allocation. That's kind of how I do the math. So this one, 2.56 times 6, okay, that puts me, that is a 6.6, so that puts me at about 15. That's well above 1. No matter how I end up with, it's going to be a number well above 1. So that would mean I could theoretically apply a 100% allocation onto this. Make sense, guys? And here's an easy one, 0.51 times 1. Well, basically, that's going to put me at 0.51. Then times 0.51 again puts me at 0.26 or 0.27. So that tells me I could apply possibly 20, 25, maybe 30% allocation to this trade given what I'm seeing here. That's the easy way for you to determine allocation. Okay? It allows you to limit risk, let the trade do what it's supposed to do. You're going to take opportunities when the numbers tell you that it's got a fairly high probability of success, but then you're going to leave most of your money in cash or in some sort of a hedge position so that you don't get trapped trying to take aggressive trades. Here's again, let's go to Yang. Yang was a good example. Or that was, I think, the last chart. Here it is. 0.87 and 1.89. So do the math on this. We're going to end up probably around 1.57, maybe 1.6 times 0.87 is going to put us down to about 1.4. That means that you can apply 100% allocation to this, theoretically. Okay? In this scenario, like I just explained to you, 0.28, 0.50, that puts me down to roughly 0.27 times 0.28 again, puts me down to about 0.9, maybe 0.11. That means that theoretically for this HIBS, I would only be trading approximately 10-15% of my my slot allocation of $10,000. That means theoretically I'd only be putting, maybe 1,000, maybe 1,200 into the trade, leaving 8,800 over in cash. Okay, guys, let's move on to the next one. The core list has got no new triggers again, so we really only have the one trigger. And again, you can see the core list is predominantly bullish here. We need to see these reds flip into greens. That'll give us some more confirmation that we're in an uptrend. We have a couple of older triggers here. This is 41% profit, and this is 47% profit. MJ short trade, and then we have the XLE long trade, which has been around for 59 weeks. That's a little over a year. We are probably pretty close to the stop level. No, we're 10 points away. $10 away, and in this one, 4, 5, we're about $1.50 away on this one. We are going to get more triggers. They're just not coming because the market is flat. You need to be aware that in a flattening market, the way this is designed to work is you will stay effectively hedged. Let me show you what you would be doing by coming over here and opening this up. So you would be staying effectively hedged. You would be not trading so much. And I know that sounds boring, but that's the way it is. There are times in the market when you want to protect your capital by staying away from risks and learning to allocate efficiently. Okay, theoretically, we only have one new trade and a couple of trades that are 4 to 10 weeks old. So in reality, you would have, of your 25% allocation for stocks, 50% in cash, 25% in metals, you'd really only be taking 1 or 2 trades. That would be it. The rest of it would be sitting in cash and or metals hedge, and we would be riding this thing out, waiting for the next opportunity to come. There's no reason for you as a swing end of day or weekly swing trader to be aggressively trying to scalp 20 cents or 50 cents or $1 off of weekly trends right now. It's just the market is not going to give it to you because the market is trading sideways and flat. Eventually, we will get into a trend, and that's where the real opportunity comes. I think that's going to come in around July or August, like I've been saying. Overall, the weakness that we saw in the MENT rotational modeling system is likely a pullback in a flagging, or what's called a false breakout in a flagging formation. We're likely to bottom and try to move higher. Now that we're in March, once we get past March 8th, 9th, 10th, I think you're going to be surprised at how strong the market rallies in the face of potentially rising Fed interest rates again. And the reason this is because throughout the globe, the U.S. market is still the strongest, most dynamic, most diverse, and most capable economy on the planet. So understand that, while the rest of the world is struggling, trying to contain credit debt issues, the U.S. market is still the strongest, most diverse, most capable economy on the planet, and will likely stay that way until some type of credit event or massive catalyst event disrupts the shift in capital that's currently taking place. Okay, guys, let's be aware of what's going on. Remember, come to my website. Let me go over here. Come to my website, take a look at what I have going on, share with your friends, try to join the MENT Expert Growth membership plan. It's really worth it for you to get this type of content and research every week. And I have more tools and resources coming out for you. I'm building all types of great things. Most importantly, folks, I've been building this. Let me show you this. I have been building this TT3 MACD scanner. Okay, I got to drag it around a little bit. I've been building this TT3 MACD scanner, which is designed to help you become a better trader. And the goal of this is not to have you rely on me, so to say, hand-holding you, making decisions. I want you to be able to make decisions. I want you to be able to understand how to read this, and I want you to become a better trader over time. So it is a matter of learning. It is a matter of planning and preparing. What we're doing is we're trying to teach you how to become a better trader. This is a gold back test. I'm trying to come back over here, find the SPY. I don't think I have it. Let me come back here, turn this off, set this up as SPY. Come back here. Obviously, yes, because I have it set up inappropriately. So commissions per contract is $1 per trade. And this is daily. We'll flip it to 5 minute, see how it does. Still does not perform very well. This was set up for gold, so it's not going to really work for the SPY. Let's try weekly. And a little bit better. But part of what I'm doing is trying to refine this so you have setups. The idea here, again, ladies and gentlemen, is you come in here, you learn how to set the inputs so that it works efficiently. You learn how to follow them. And like I said, the idea here, again, is that, down potentially on a 10-minute chart, you come in here, you look at the SPY. This is yesterday. We had a nice solid gap in the morning. This is 10-minute. This is daily down here. So let's set this to 10-minute. Make sure I'm on the SPY. And you can see here we had a good solid buy trigger here. We were in upper sloping Donchians. We were upper sloping wave trend 3D and upper sloping linear regression channels with a tight, narrow range. This is ideal confirmation of this trigger. We're above the Donchian cloud. We have a great sell trigger. We have a target area here and a target area here. And pretty much all day long, it stayed solid all the way up. Green, 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 upward sloping channel, upward sloping buy trigger on the TT3 MACD strategy. The idea here is to help you guys understand how to trade, how to see the chart, how to find opportunities. And remember, you don't want to be, counter trend this. You don't want to be selling into this upward trending. When you have upward linear regression channels, upward wave 3D, upward Donchian channels, upward TT3 MACD systems, this is a good solid opportunity for a rally phase. Just like this was a good opportunity for a downside move. Here's a sell signal. We got downward trending. We got downward trending. We got downward trending. It's beautiful. It's nicely set up. Nice narrow linear regression channels. This is your opportunity to the downside. We got stopped out here. Then we got another trigger here. Came down and hit our targets. Got stopped out. But understand, the idea here is for you to become better traders. When the linear regression channel widens and goes sideways, we have a real risk of extended volatility. So you have to be careful of these wider Donchian or linear regression channels. This tells you that we have a real risk of extended price volatility, which means your trades could get, moderately crazy, because price volatility expands in a larger upward linear regression channel in a wider range, and price volatility and momentum consolidates in a narrow linear regression channel. Okay, follow me on Twitter, follow me on YouTube, make a point to come over here to MENT.com, please. Share with your friends, show with them what I do, follow along, because the big opportunity is coming. You just got to hang tight until we get past March, April, May, June, and then in my opinion, July, August, September is going to be very solid opportunity for everyone. Talk to you soon.